Good morning, everyone. We'll be starting in a minute or so. Just a quick sound check. Could you please type a 1 into the chat window if you can hear me okay? Thank you. All right, I see a few ones. Perfect. Thanks. We'll start in a minute or so. Just wait for more people to join. Okay, let's get started. Good morning, everyone, and welcome to today's Tuesday Market Outlook session. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I am going to be walking you through how I am viewing the current markets. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So our agenda for today, starting off with the major equity indices, highlighting some key areas of support and resistance. But we know that right now, this week is going to be a major week for markets as a whole. You know, we have the elections coming up, but we also have inflation numbers. And I personally believe that the inflation announcement will have more market volatility than the actual election results itself. But interesting week ahead. That being said, a high volatility week expected. And I do truly believe that this is more of a week of reducing exposure rather than adding exposure. From there, we'll be moving on to the fixed income markets and commodities. We'll take a look at the sector rotational model as well, highlighting some of the sectors that are outperforming and underperforming the overall market. We'll take a look at some of the subsectors of interest that I have for you today. And we'll end today's session covering some bullish and bearish market observations. Haven't really added any new market observations since last week because, again, I don't really think right now is the time to be adding exposure. However, we will be looking at the previous market observations, seeing how they performed and when would have been the ideal time to close those trades, or when would have been the ideal time to maybe remove exposure from that trade. So kicking off with the Fed rate hike probabilities. And last week we had a 75-point hike that was largely expected, that was priced in weeks beforehand. Currently, though, we are sitting at the target rate of 375 to 400, and the next meeting is on the 14th of December, so around 5 weeks away, 6 weeks away. And right now, there's pretty much a 50-50 split here between a 50-point hike and another 75-point hike. So we have 52% probability based on Fed futures for a 50-point hike, which will bring rates to 425 to 450, and a 48% probability to bring rates to 450 to 475, which would represent that 75-point hike. And there hasn't really been too much of a change. Even from last week, you know, we were sitting at pretty close to 50% for both outcomes. However, a 25-point hike here, that has definitely been eradicated. That's due to the fact that we increased rates by 75 points last week. But overall, you know, this number is going to change quite a lot ahead of the announcement, because we'll have 2 inflation announcements before then. Obviously, one this week, the following one in early December. And that's going to play a huge part into these numbers moving. And we have to remember that, though, it's really the the speed or the acceleration of the rate hikes or the expectation of the rate hikes, that's what's driving markets. So it's always important to just touch base on this every week or so, just to see what markets are potentially pricing in. Because if, let's say, for example, if we have a bad inflation reading this week, we're going to see the probability of a 75-point hike increase, and that will be a strong headwind for equities. Whereas if we have a good inflation announcement, most likely we'll see the probability of a 50-point hike increasing, and that would be a nice tailwind for equities to actually move higher. But again, it's still very data dependent. All right, so taking a look here at the S&P using SPY ETF. And right now, price is at the 38.2 fib level at 380. This is an area of resistance, set to open a little bit higher last time I checked. But overall, we see price, even though it is at the 380 level, I would say this is actually more of this area here is more of a valid resistance level. We can see price has reacted to that area as support and resistance more recently. So that would be the potential upside movement here that I can see for the S&P. The next key area of support, though, would be at around the 350 area, which would be the 50% fib level, or even 360, which we did see price somewhat stall at for a few weeks. So those would be the key areas of support and resistance. I'm not going to really speculate too much this week as to where I believe price would go. Obviously, with the election results and with the inflation numbers coming out, it can go anywhere. And I don't think right now this week isn't really a great time to be speculating on markets unless you have a very good risk to reward. So I do think that a strong fundamental catalyst is what's going to be required for price to actually break above this previous swing high for a move higher to the 404 level. And that fundamental catalyst would really only be a good inflation reading or any dovish comments from the Fed, which we still have not received yet. And shifting our focus to the NASDAQ 100, we can see here the NASDAQ 100 is at a key area at around between a 262 area and around 269 or so, 270. So this is the area of support. It has acted as support now for a number of weeks. And even though the trend is quite bearish, price is still maintained to stay at this level. And I wouldn't say there's a lot of momentum to be found. We did have about a multi-week relief rally, but again, on a daily time frame. But again, that really failed to break above its 55-day exponential moving average. Overall, momentum still remains negative. And remember, the NASDAQ 100 is still very exposed to rises in interest rates. So that is why we are seeing a strong underperformance against the S&P 500. And it is going to be under pressure against a stronger dollar, because remember, with the NASDAQ 100 being so exposed to technology names, and technology names having doing a large amount of business or conducting a large amount of business outside of the US, and they're very multinational, they tend to be more exposed to that rising dollar as it works against them. And that is what we are seeing now with the technology sector and the NASDAQ 100 underperforming. That being said, if we do see a break below the 260 level due to any fundamental catalyst, and the macro outlook still remains negative for the next few weeks or even a couple of months, I wouldn't be surprised to see price actually reach that 236 area, which is the next major support level. But that will be, if we do get another bearish leg down, that will be the next target area that I would be looking at. But again, very data dependent right now. And you can see the markets are consolidating a bit more over the last few days, waiting on not just election results, but also inflation numbers. Looking at small caps, so small caps still performing quite well relative to large caps. There's actually a ratio chart that we'll take a look at next. But IWM still above its 21 and 55-day exponential moving averages, finding support there or rejecting those levels on Friday and even yesterday. So in terms of the potential upside move, I do see 188 as the next key target. That will be the 38.2 fib level on the weekly time frame. And the next key areas of support, even though we have a 50% fib level at 170, I would view the 163 as a more stronger area of support. As we can see, price actually made a double bottom on the weekly time frame. and managed to move higher with some pretty decent momentum, especially when you look at it relative to the large cap names. So good outperformance for small caps, which is refreshing to see after a very long period of underperformance, especially, you know, like almost 2 years now from 2021, we've had some strong underperformance here for IWM, but there's some signs of life getting back into small caps, especially when you take a look at this chart. This is a ratio chart. It's small caps versus large caps. So I have IWM against the SPY ETF. And basically all this is, it compares the performance of both of these ETFs and looks for outperformance and underperformance, right? So if the chart moves higher, it means IWM small caps is outperforming the S&P. And if it moves lower, it means that the S&P is outperforming large caps. So if we take a minute to look at the weekly time frame, we obviously had, you know, the pandemic and the recovery period after the pandemic, where we saw small caps have this monumental rally, monumental outperformance as well, relative to the S&P. This happened late 2020 or mid to late 2020, and even early 2021. And then we saw small caps essentially from 2021 to 2022 for one entire year consolidate and just be very range bound. At the same time, the S&P and the NASDAQ, the large cap names, they were moving higher. Those indices were moving higher, which is why we then saw this strong underperformance for almost a year. And now we're at this range on the weekly where, you know, price did manage to stay within this range for most of this year. But the interesting thing that I'm seeing here is this breakout for small caps relative to large caps. And traditionally speaking, I'm not saying this is going to be the case this time, but traditionally speaking, before a bull rally, we tend to see small caps outperform large cap names. Now, that just kind of adds to, you know, a few things that have been noticeable when you look at markets over recent weeks. There's been a lot of technical factors that indicate a reversal is on the cards or a move higher is on the cards, but the fundamentals still remain quite bearish. So now we have this contradiction between technicals and fundamentals. And this is one of those confluences for the technical picture of small caps starting to outperform large caps, indicating that we might see better performance for the market overall coming up ahead. But again, I'm going to repeat what I'm saying here, very data dependent. Let's see what happens with inflation. Let's see what happens with the Fed. So another reason that I wanted to say there's this contradiction between technicals and fundamentals is simply due to the VIX actually moving lower. And that's normal to see when during a market recovery, right? We tend to see the VIX to move opposite equities. And we haven't really seen that in recent weeks. So not only has the VIX moved well below the 30 area, but in recent weeks, even on bearish days in the S&P, the VIX has continued to move lower. And that is, in my opinion, a very bullish sign, because one of the signs, again, another sign of a market reversal is during a bear market, when inequities continue to move lower, but the VIX also moves lower, that indicates that there's a reversal on the cards. And we have seen that in the past, and it's looking like we are seeing that again. It's not necessarily accurate from a timing perspective, but it does indicate that maybe, you know, we are at the tail end of the bear rally, and when you of the bear market. And the thing about bear markets is they tend to be short-lived, very short-lived. But yes, they are quite violent. We do tend to see higher volatility, but they are short-lived. And we've been in a bear market now for quite a few months. So I do think, you know, the timing of the VIX, the timing of small cap outperformance towards the tail end of a bear market does indicate that we might have at least reached the bottom. I don't necessarily believe we'll have a very strong recovery the way we did during the pandemic recovery period. That's simply because of higher interest rates. We are not in a loose monetary condition environment that supports a huge rebound in equities, but at least this could confirm that we have reached a market bottom, or we're going to at least start forming that bottom base before eventually moving higher in the months to come. All right, so taking a look at TLT, and actually, sorry, one thing I forgot to mention, in addition to the whole technical picture contradicting the fundamentals, was actually for the S&P. And I know I mentioned this last week, but we are seeing a positive divergence everywhere on the momentum indicators. So we're seeing price make a lower low, and we're seeing momentum not confirming that and actually making a higher low when price made a lower low. That is known as positive divergence, and it's a very, very bullish signal as well. And which is why we did see this this rally here that actually managed to break above this previous swing low and break above the 380 level. So again, it's just another reason or another confluence with confirming that the technicals are really, looking for that move higher, but they do need that fundamental catalyst. And again, that fundamental catalyst would either be lower inflation or more dovish Fed. Those are really the two fundamental catalysts that I can see that would really be able to shift the bearish sentiment that we currently have and to align the fundamentals with the technical picture as well, because it does look like markets are now ready to reverse higher or at least not move further lower. They just need that fundamental catalyst to confirm that. All right, moving on to TLT, which is the bond ETF. We had a look at this last week. We looked at the 21-day exponential moving average on the daily. Price was struggling to break above that, and it is well on our way towards our downside target of 89. Bonds naturally under pressure due to the higher interest rates. But again, let's see what happens with inflation. TLT will be quite susceptible to any movements in or any drastic movements with inflation. Better than expected inflation will likely see a rebound here higher for TLT, even if it's just for the short term. And looking at the dollar. So the dollar, we highlighted the 110 area acting as support, which once again today so far, it is finding support at that level. But we're also seeing a lot of consolidation now in the last few weeks, right? We saw this monumental rally all the way to 115, strong rejection. And then 114 really acting as resistance after we saw multiple rejections of that area, but price not really breaking below 110. So the fundamentals in the macro picture for the dollar still support a stronger dollar. The currencies, or the basket of currencies that the dollar is exposed to, those central banks aren't raising interest rates at the rate that the Fed are raising interest rates. So naturally, the dollar is going to be a lot stronger, but it has also approached that overbought condition, especially on the weekly. So a bit of consolidation here is, that was definitely expected. But really what this means is if we take a look at gold, and we know that dollar and gold move inversely with one another. And gold over the last few days has had a very monumental run. It has found support at around that 151 level, price struggling to break below that. But with the dollar essentially reaching that area of reaching an area of support, the risk to reward favors a downside move here in gold. And this area has acted as resistance in the past. We're seeing bearish intraday price action as well. I would say that there's an excellent risk to reward bearish opportunity for gold, all the way back down to potentially that 151 level. And taking a look at oil using the USO ETF. Oil, after consolidating for quite some time, not very, very choppy price action, very difficult to really look at a lot of energy names. We saw this gap up higher, and price actually rejected yesterday that 78 level and set to open a little bit lower this morning. Overall, though, when it comes to oil, the macro picture is very much dependent on the supply and demand relationship. On the demand side, we have a lack of demand due to a recession, right? Those recession fears as well. Naturally, we're going to see a demand in oil, and that will bring price lower. However, on the supply side, we know that the oil producing countries are continuing to cut supply to keep oil prices elevated. So between that tug of war, I would say more recently the supply side is winning, and are keeping, or I should say, they're keeping prices high by cutting down supply. And that is why we did see, again, a big move higher here for oil. But overall, this is very choppy market right now. Very difficult to trade and very difficult to analyze, in my opinion. Okay, taking a look at sector rotation, we have 6 sectors in the improving and leading category. we have 5 in the lagging and weakening. So the 6 sectors in the improving and leading category, we have energy, financials, healthcare, industrial, staple, and we have materials here in the improving category. Energy providing some very good leadership due to the recent oil rally. Obviously, a lot of energy names are exposed to oil prices. We have financials as well, surviving this earnings season and actually performing very well, which is why we are seeing it again provide leadership. The big surprise is healthcare. Healthcare, naturally a defensive sector. So it does indicate that investors are still uncertain about what is happening with in the current environment and are naturally rotating towards healthcare, which is why we are seeing it perform quite well. Industrials, it's been in the leading category for quite some time, but not much to say on that. And we also have staples moving from the weakening category and into the improving category. So again, that's another defensive sector. So just to reiterate the fact that investors are still uncertain in this current environment and are naturally rotating towards defense. The one exception to that, though, is utilities. Utilities very weak right now, seeing a lot of outward rotation, heading towards the lagging category. And this is simply due to the fact that higher interest rates make municipal bonds less attractive, and we aren't seeing a natural rotation out of utilities. We have real estate and technology still in the lagging category, not showing much momentum to move into the improving category. And we also have communications, which has pretty much stayed between this lagging and improving category for most of this year. But those are the 3 weakest sectors currently. So taking a look at some subsectors of interest that I have for you today, we have DRIV, which is the Autonomous and Electric Vehicle ETF. So once again, we are looking at this name because I do see a good risk to reward bearish entry point. Price is now at the 21 level, 21, 22 level, and it's again showing some bearish price action yesterday. So from a risk to reward perspective, excellent bearish entry. We have that move lower on the cards, all the way back down to 20 or even 19, with 22 acting as resistance. So if price does break above that level, it's a trade that you can close for a very low loss, whereas it's more to gain, plenty of downside to gain here. And even if you look at the names within this ETF, there's a lot of semiconductor names. And, you know, looking at the semiconductor sector itself, or subsector, using the SMH ETF, we can see that semis have been under pressure. And I'm not really talking about the more recent price action in the last few days, where we have seen 3 bullish days in a row, but I'm talking about the last couple of months, where overall price has been on a downward trend, but the relative performance over the last few weeks, when price was recovering higher compared to the overall market, where, you know, the S&P broke above its previous swing high, semiconductors and SMH have not. There's still a lot of downward pressure here for semiconductors, and when markets do turn down, do have another bearish leg or move lower, I do expect semiconductors to underperform even further, which is why, you know, with DRIV having such high exposure to semiconductor names, it's still very vulnerable for that move lower. And also the macro picture for semiconductors right now isn't that strong. We have limited trade with China, and that's a huge market. That's the second biggest economy, you know, and that is why we are seeing that strong and longer term underperformance here for semis. So the next key area of resistance is at 200. So again, good risk to reward bearish entry points anywhere from 195 to 200. Should we start seeing some bearish price action for that move lower to 170? And both the technicals and the fundamentals here in this case support a bearish thesis. All right, taking a look at IBB, which is the biotechnology ETF. This is a name that we looked at last week. We saw very strong outperformance here, very decent momentum, a nice pullback towards the 21-day exponential, and some bullish price action here. The reason this is on my watch list is that I'm looking for a move higher to 133, 134, which is a major resistance level for this year. You can see price has never really broken above that level for 2022. So I'll be looking for the move higher back to that 133, 134 level, looking for some bearish price action. And from there, that will provide an ideal risk to reward short entry point, or at least a bit of a fade here for biotech. I don't believe that it has a very bearish fundamental thesis, but this is more of a technical trade. So maybe a very short-term kind of bearish play should it reach that 133, 134 level. Right, taking a look at another name that we have looked at the last few weeks, and that is Tesla. And Tesla, this is a name that has now invalidated my thesis of 200 acting as a major support level. Well, it did act as a major support level, but that level is now broken. We saw a strong move. It originally started off as an earnings play, and I had a neutral to bullish earnings play because, should price price would have to it would have to be a very bad earnings announcement for price to actually break below a major area of support in an oversold condition. And that's exactly what happened. Even though it missed earnings or revenues by $500 million, price still maintained above the 200 level and actually managed to move higher. So this would have been a profitable trade setup, depending on the strategy that you used as an earnings play. But since then, it hasn't really found that momentum, struggled to break above its 21-day exponential moving average, and it's now back below the 200 area. So this is a trade that you would now close. The thesis has been invalidated. And probably best to just move on to the next trade, because the next key area of support that I would see would be at the 150 area, around there, previous resistance on the weekly. So there's significant downside potential here for Tesla. Another name that I'm still quite interested in is CrowdStrike. So CrowdStrike, over the last couple of weeks, I highlighted the fact that it's still in a very strong bearish trend. We are seeing a relief rally, and I was looking for a bearish entry point at around that 165 to 170 level. And we did see some bearish price action there, very strong bearish move. So this is a setup that has worked well. But the reason I like CrowdStrike is the fact that it's a long-term bullish play. This is a cloud security provider, very well positioned within their industry. And there is some long-term bullish potential here for CrowdStrike, in my opinion, despite the fact that it has high valuations, despite the fact that it's unprofitable. There are a lot of signs, especially with improving EPS trends. There are a lot of signs that this is a company that's actually making the right steps to being a profitable company. So for that reason, long-term bullish on CrowdStrike, and this with price now at that 120 level, especially from all-time highs at 300, price now at 120, this is where I'm probably going to start thinking about accumulating shares for that longer-term bullish thesis. Taking a look at JP Morgan. So JP Morgan, this was a trade that again went against us. I was looking for a fade last week of that 127 level, especially after price was so heavily overbought. There was such a strong move towards the 127, 128 area. And we did see some bearish price action last week. However, that became invalidated on Friday, where price managed to break above and close above that 127 key area. So still, at the end of the day, it was a good risk to reward bearish entry point, just didn't work for us. And it'll be a trade that you could get out at for a limited loss. And Rockwell. So Rockwell, another name that we have been looking at for quite some time. And we can see here the thesis for Rockwell was 260 acting as resistance, major resistance level here, especially on the weekly, as you can see. And since then, price did manage to have a huge move lower. And this is one of the trades, well, this is the type of trade where, after the significant gap lower, if you see any bullish price action, you'd want to actually close a trade instead of keeping it open for a move lower, because what tends to happen is, due to the gap fill opportunity that exists, bullish price action after a gap lower would indicate a continuation higher to fill that gap. And it looks like that is what we're currently seeing. So in this case, better to I know it was quick in, quick out kind of trade, better to kind of get out of this trade now rather than waiting for another reversal lower after this gap fill. And with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week. I will see you next week, and I'll also see you tomorrow for the Greeks educational webinar. So very excited for that webinar. I think we've been building up to this now for a couple of weeks. So me and Jessica Inskip, our Director of Education, will be hosting it. And yeah, I hope to see you there. Thank you so much and have a great week, guys. Goodbye.